All right, welcome to the Emerson Group Wealth Call for April 2025. And today I'm excited to be talking about alternative lending options for rental property owners here with Mark Feder.
Hey, thanks, Nick. Thanks for having me.
It's going to be a great call. So I'm super excited about getting into really helping you understand what all your options are in the playing field for business use, also for rental property ownership in general. And understanding, in some cases, maybe the traditional, conventional 25% down is not the best option for you at that particular moment, or when that opportunity happens to come across maybe your desk or maybe on your phone, you're able to take advantage of it because you know what all the different levers are and how you might be able to take advantage, because there's more than just one option out there in the marketplace. So I'm really excited to just really get into this and help you understand those options, and have Mark Feder here with Pacific Home Mortgage, and he's going to be able to really help us understand this because, well, Mark is an investor too. So we're all playing this game together. He has plenty of doors in San Diego and has plenty of experience in that space, so that I thought that'd be amazing for you as an audience to hear him from a more detailed understanding of being in it himself and knowing what situations you might find yourself in where it might not always be exactly the way you plan for it to be. It might not be linear, but if you have kind of all the options and education available to you, then you can make the most of that journey and make it as best as possible, which is build wealth and pass it on to family and keep playing the real estate game. So Mark, tell us about kind of your background and what we're talking about today.
Absolutely. So I started doing loans in 1995, and I started doing loans in California in 2002. I have been buying rental properties since '02, and I got into it in a much more heavy way in '08, '09 after the financial crisis.
The good times.
Yes.
Depending on what side of the coin you're on, of course.
I was on all sides, so some good and
so
some
you
bad.
felt small, okay.
Yes, but so I own over 30 rental doors here in San Diego County. I've done some development. I've done a lot of buy, fix, and resell, a lot of long-term investment, and I've been in the mortgage business and have seen a lot of different opportunities and different situations over the years.
Yeah, well, that's huge, right? Just understanding what it feels like to be the client and kind of what you're going through and what needs you might have or what information you might not know about, right? You understand what that could look like, and then on the flip side, kind of help them understand, hey, this is what is out there for you in the menu. Now let me help run all the numbers for you, because Mark knows the numbers, right? Understanding what do these numbers do for me? What does this look like from an ownership standpoint? And why might this option make more sense than the alternative, which is far different than a lot of the lending out there, where really they're just there to take your order, right? What loan do you want and for what amount? And I'll let you know if I can get you approved for that amount. That's not the conversation we're having today, thankfully. Thanks to Mark. And let's kind of get into who's the typical client that you're serving and would most benefit from a lot of these products and knowledge that you have in this space.
Sure. So on the investment property type of clients, a lot of them are clients that have 2-3 rental properties, and they want to get a third or fourth or a fifth one. Sometimes it's a first timer. A lot of people out there do really, really well financially, but don't show that they do that well in their tax returns.
Why would they do that, Mark?
Well, there's a number of reasons they might not show it. It could have been they had an off year, maybe they had some big expenses the year before, or it could have just been something inconsistent that was a once every 5-year type of situation. Those
case in point right here, as a real estate broker, I had one of my first years, we actually went down in sales last year. And now I'm currently looking at a property to purchase, and it doesn't matter that the 10 years before that was great. It's the 1 year was not as great that is a constraint for me. Now it limits my options from as far as what I can buy or how I can buy it.
100%. So in your situation, it'd be difficult to get what's called a conventional loan, which is a typical loan that'd be offered by a bank or a mortgage bank. In that situation, you might be better off getting a 12-month bank statements loan where you're showing some deposits, or it could be if the property's rent or potential rent is high enough to cover the principal, interest, taxes, and insurance, the property itself might be able to qualify.
Okay, this is a perfect segue into just getting kind of a better understanding of what is the flow of why people would need a non-QM loan, right? Like, how do you end up in this conversation? Because a lot of people don't ever end up in the conversation, right? So why are we needing this types of product or options available to us? what's going on that would cause that, or what is our situation, right, from a financial or ownership standpoint that would cause the conversation to be focused solely on really non-qualified mortgage options, right, that are not funded or liquidated from Freddie or Fannie.
That's correct. So the way you want to think about it is, on an investment property loan, a conventional borrower typically would be a W-2 borrower. Maybe they're buying their first or second investment property loan, they have it in their own name or the name of a trust. And if you want to look at their overall picture, maybe they're 80% working and 15-20% real estate.
Okay.
The non-QM side tends to be more for someone who is either already self-employed, so they're going to use their bank statements to qualify, or they've got more than 6 properties, as there's some restrictions on having more than 6 loans with some conventional lenders. They want to have it owned in the name of an LLC. They already own it in the name of an LLC, and they're doing a 1031 exchange, and they have to keep it in the name of the LLC.
Right.
Those aren't allowed in conventional loans. You have to use a non-qualified mortgage type of lender.
So the journey, right? It's really the journey of you start earlier on in your years when you're in the high income, you're in W-2, and you don't have a lot of assets, so the structure is rather simple.
Yep.
As you layer in and start to accumulate more assets, and then you also start looking at the other implications of doing a 1031 tax game, you start to get into situations where it's a more nuanced structure, and then the implications of how your income's on paper because of rental income versus, so you start to really get into more of the non-QM as you're further into the journey or in the journey longer.
100%, and you could be looking for a different product. It might be that you want a 30-year fixed with a 10-year interest-only option because you want to have low payments for the first 10 years. It could even be a borrower who was always on a conventional loan, and last year they just did a ton of repairs, not capital improvements, and they wrote off a ton of repair expenses, and they might not qualify for a conventional loan, even though they rebuilt the staircase, they rebuilt the roof, and they rebuilt a bunch of other stuff. We can still get them into a non-QM loan.
Perfect. I really wanted the audience to understand, who is this person? Who or when might you need, to consider these options? And also the what, meaning an opportunity comes, in the form of a phone call that so-and-so, passed away and they're looking for someone to take over the property. And, well, you didn't plan on buying real estate this week. So you're probably not in a position to take advantage tomorrow. Yet, if you have different of these menu options in this product line, you can.
100%. You just want to know that it's out there. It's worth having an initial conversation early so that when you find yourself wanting to buy more real estate, you understand, how am I going to go about doing that and what's that going to look like?
And I don't know about your journey, Mark, but so far in my career, what I've learned is that when I prepare myself for the next opportunity or the next property, it tends to show up when I'm prepared.
Yeah.
Meaning I lined the right people up, I've gotten the right lending options, and now that I'm in a position to take action, eventually something will come to my desk and I'll say, I'm glad that I did, because had I not, I just wouldn't have had open hands to take advantage.
Yeah, no, I mean, the other way to look at it is, if you want to be able to eat your fruit, you need to be planting your seeds. And planting your seeds is saving the money, it's talking to the advisors.
It's getting educated on our YouTube channel, to understand how do you put yourself in the best position for a future event.
100%, yeah, no, it's worth it to spend the time now so that you're ready in the future when it comes.
Perfect. Okay, now that we've set the kind of landscape for lending options here in the non-owner occupied and business space, we're going to get into more of the details for each option in the menu. So we'll kind of start with the traditional, conventional, non-owner occupied.
Sure.
25% down.
Yes.
So in
general, that type of customer usually is going to be a W-2 employee or they're self-employed, but they're showing a lot of income after the write-offs and being self-employed. Okay. They're comfortable owning the property in their own name or a trust. They don't have it in an LLC. So they're also very comfortable putting down 25%. And once they have, depending on the program, 6 loans or 10 loans, they start to pay basically penalties or extra pricing because they're considered to be deemed risky in the conventional world.
So one thing I want you to hear is as you layer, additional ownership of assets, the structure in which you own them, then you're starting to play some of the tax implications in gain, the 1031 exchange. by default, you almost end up, it's like you end up in the winner's club because you need to get a bank statement, which tells us you maybe did some things right by having a lot of investments in the conventional. You can't do it anymore because you have too many conventional. So it's like, depending on what level you're playing this game at and the complexities that you might face yourself in or the planning of it,
Yep.
right? This is exactly why knowing which one for which bucket for maybe which year, like, generally I'm a conventional, but last year, for me personally, right, my income went down, which as soon as my income goes down for a year, they can't use any year prior as my qualifying income.
Correct.
So regardless of how great my year was before that, if my revenue
Or
went down,
how great it is right now.
yeah,
Halfway through the year, it doesn't matter.
right, which is just like, man, I got to take advantage of this opportunity, and this can't be the reason why I don't take advantage.
Yes,
So you're conventional, you have a couple properties, and you're not going to be looking at the bank, right, the bank loan or the DSCR per se, unless, like in one situation, would you go initially from conventional to those other?
Oh, so I mean, it could be a year where maybe you want to buy 3 properties that year because you see it's really working.
Right.
But you don't have enough of a track record to support everything. So the bank won't give you, on a conventional loan, enough credit on the properties you already purchased because you haven't been doing it long enough to satisfy a bank's underwriter.
Or you change a job, right?
Yeah.
Like, you're an investor, you have assets, yet on paper you went from your main source of income in one industry to another, and now you
Now your
have
income is zero.
qualifying
Yeah,
purchasing power.
your qualifying income on a conventional loan then goes to zero.
And you're to zero until you have 2 years.
2 full years of tax returns, W-2s, or 1099s.
So, Bill, would you wait 2 more years to sell your property so that I can make sure that I have it? No, okay. Let me see what else I can do. I'll call Mark.
Yeah, we call it being in the penalty box. When someone makes one of those changes, it's like in hockey, they have to sit in the penalty box. Instead of sitting there for 5 minutes, you're going to sit there for 2 years.
It's not a penalty though. I want to change that maybe. But
No, I understand, but they can't do the conventional loan. So
it's a non-QM box.
It's a non-QM, yes, it's a non-QM box.
Okay.
We'll have the non-QM hockey box.
Okay.
So that allows them to get back in the game faster at the end of the day. And depending on what type of a non-QM loan or non-qualified mortgage loan an investor would be best suited for, is what you would end up offering them. So you could have one where if the rents on the property were high enough that the property can cover the principal, interest, taxes, and insurance,
Right.
and in some cases just the interest, taxes, and insurance.
So real quick though, so we have conventional, 20% down, we explain kind of who that might look like or their situation.
Yep.
Then we're going to the DSCR, which is a debt service coverage ratio loan.
Correct.
Right, so tell us a bit about how it works and.
Sure. So that loan is very good for someone who is more of a professional real estate investor or somebody who is looking to have the building itself qualify for the loan.
Okay. The building itself qualify for the loan. What do you mean by that, Mark?
So I'm not going to ask a borrower what they do for a living
Okay.
if they get a debt service coverage ratio loan. They could be a doctor making $3 million a year, and if the rent on the building is $1 and the mortgage, tax, and insurance are $10 million, they're not getting the loan.
Right. Okay.
And they could be someone who works in a minimum wage job, but they found a great deal, and the principal, interest, tax, and insurance can be covered by the rent. If they've got the down payment to make it work, they'll qualify for the loan.
So it's almost like commercial versus residential for the DSR. You can look at it like commercial loans. We are looking at the asset and the power of income that the asset generates, and then all the debts, right, associated with the mortgage, insurance, interest, taxes are all covered within the cash flow of the asset. And if that works out, then you have an opportunity to apply for a loan and not have to worry about what you're personally doing in your business or your profession.
That is correct. You could have just switched jobs. You could have just started a brand new business. If you find the right property and that property has enough rent to qualify, you can still buy the property.
Okay, so with the DSCR, I wanted to just expand on knowing that you have different options within down payment too.
Sure.
Right, so like the debt service coverage ratio doesn't necessarily have to be, hey, it's X% down for X property. It's really what's the property generating income,
Yep.
how much available liquidity or down payment do you have,
Yep.
and then does the opportunity fall within the appropriate metrics to qualify for the product?
100%. And you could even have scenarios where sometimes you'll have partners. I mean, I've seen it where you might have a grandfather and granddaughter, and the granddaughter really wants to get into real estate investing, but she's starting out in her career. She doesn't have the down payment money. Grandfather has a big chunk for down, doesn't want to go spend the time to go and find the property.
She's got the time, the energy, he's got the money,
He's
we've
got the
got
money.
a collective partnership.
Yep, they form a partnership, whether they do it, they buy it together in their individual names, whether they form an entity in an LLC, but all of a sudden they can go out and start finding properties, and if they want to put down 50%, they can put down 50%, and they can see how it goes. And so long as the rent's enough to cover the taxes, insurance, and interest, the property itself will qualify.
So this is an example where you can take action on this piece of education, which is, okay, great. So what I just learned is if I have someone in my family, a friend, or someone in my network who I know has available money on the sideline, because it's probably not on the stock market right now,
Yep.
or hope not, and they're looking to put that money to work, and well, you're excited, you're energetic, and you're intentional, and you want to be in real estate. So there's an opportunity where you guys can partner together.
Yep.
And then you're just focusing on how do I find assets with the highest producing income potential or actual. And that's my model now. Because I learned, like with DSCR, as long as we can find assets that generate good income and support the debt service ratio of what we need to qualify, we can keep doing this.
Correct.
So that's huge for people to hear, just understand how I can apply what we're hearing right now, which is just acknowledging, hey, if we don't have the income for it, or maybe I have a partner with capital, but we know we want to buy more than one, so we can't spend it all on one purchase.
Yep.
This is a way where you can start planning out, how you can buy multiple assets in a period of time without getting stuck.
Yep.
Or having to unwind all your hard work because you didn't think about it from the beginning or know which product to use or why.
Yeah, 100%. And then even if you think about just from owning property perspective, sometimes you'll buy a property, you'll think the rents are going to be $2,500 a door, but something's happening in the neighborhood, there's a new restaurant or bar, something's made it more desirable, and all of a sudden you're getting $2,700, $2,800 a month. You can act quickly. You don't have to wait for 4 years to resave that down payment. You can partner with someone, use the knowledge you have and your experience in the marketplace to take advantage of what's out there today, but that the market hasn't yet priced in.
That's right. Well, that's a good product option, and there's other options available. So what else do we have besides DSCR?
Yeah, another one would be bank statements. So this is typically for somebody who's self-employed, who for some reason or another their tax returns do not show enough income after all of their write-offs to qualify for a conventional loan. We have multiple loan programs available where they can show us their 12 or 24 months personal or business bank statements, and we qualify the income based on that, and that can also allow them to buy a rental property loan.
When you say you qualify it based on just that, what do you mean by that? So we'll qualify you on 12 months of bank statements. Well, what are you going to qualify us on?
We'll look at your deposits that are from your business that are either recurring or likely to reoccur. So if you yourself, lend your company $100,000, we would back that up. We wouldn't use that money because that was a loan that a shareholder lent his business.
Right.
But if it was customer deposits, we'll look at those and we'll look at an appropriate expense factor for the industry. And all these non-QM lenders have different programs and different guidelines as to what the expense factor is. So if I was selling, truck engines, they might say, oh, well, Mark, you're selling truck engines, you're only going to give you credit for 50% because we know the engine's half the price. If I'm selling a services business and I don't have any employees, they might give me credit for 80% of the deposits because they know that most of it's just my time.
Okay, that makes sense. So as far as the, this option with the bank statement goes, it's someone who maybe doesn't have the qualifying income because it was an off year, or maybe they just don't in general have the enough qualifying income because his assets, just a larger purchase price.
It could be a larger purchase price. It could even be that the in-place rents on the property for the next 6 months, it's stuck on a really low lease for $2,000 a month. But the minute that person moves out, it's going to go to $6,000 a month. So they would have qualified had the rent been the market rent, but because it's not, they won't qualify to use that rent. So they would have to then go and use a bank statement loan. So there's a million situations where you're just not fitting in the conventional box, and this basically opens the box.
That's precisely what we'll see a lot of, and that would be a common situation where, hey, I've got a really good opportunity for purchase. However, I have to spend the next 6 months unwinding all the leases or month to month that have been in place for 30 years, and they're paying $1,200 for a 2-bedroom.
Yeah.
So that's a great example, because the catch-22 that you're in is that it's a great price that you're getting it at, but the current actual income is limiting you from being able to qualify to purchase at that great price. So
Correct.
it's like, perfect, here comes a bank loan option.
Yep.
This is an option where it's a short-term position with an opportunity that justifies doing it. Like,
Yep.
yeah, it's a really good price, and yeah, the rent's not very ideal, but once they get out, we know I'm going to basically double the gross income of a rent schedule.
Yep, that would be an example. So,
And then I could back out of this in 12 months if I wanted to, right? And
Yeah.
refinance.
yes, so most of these loans on the debt service coverage ratio and the bank statement loan, they generally have some prepayment penalties. It can be as little as 0
Okay.
to as high as 5 years in California. You just have to know kind of what your plan is, and then you set the appropriate penalty so that you have the lowest rate possible, that where you don't think you're going to end up paying the penalty if you pay it off early.
Okay, so what would be like today with your product? What is a typical like bank statement, 12 months, prepayment? Like, is that a 2-year right now? 1 year?
No,
Or how does it
really
determine?
goes from 1 to 5 years. So it's just a matter of like what the lower the penalty, the shorter the term the penalty, the higher the interest rate.
Okay.
So if you said, hey, I want to get into this property in 6 months, I want to be out of it because I'm going to turn all the units over, I'm going to fix them up, but instead of having $5,000 in total rent, I'm going to have $15,000 in total rent. I'm going to say, hey, let's get a more expensive interest rate loan to start with
Right.
that has no penalty. So you can pay this thing off, because you're definitely not going to be in this loan for 5 years.
Yeah, so lenders are giving you an option for basically a liquidity event much sooner,
Yes.
which therefore, right, they want to get a better return to justify giving you that short term.
Correct. If you don't want to be
Yeah.
in the loan for long enough, and they want to get more money while you're in the loan. If you say, you know what, I'll be in the loan for 5 years, they'll say, okay, cool. We'll give you a lower interest rate,
Right.
and you'll be in the loan for 5 years. And if you're not, you can still pay it off. It's just you would pay a penalty to pay it off.
So what are like a penalty? What typically?
So it
is?
depends on the different lenders that we have. So some lenders might have what's called a step down penalty, which is like, let's say you did a 5-year penalty, 5, 4, 3, 2, 1. In the first year, if you had $1 million loan, the penalty would be 5% of that loan,
Gotcha.
$50,000.
Okay.
In the last year, year 5, the penalty would be 1%. It would be $10,000.
So it de-escalates over time. So to
That's
speak.
a step
Yeah,
down penalty.
yeah.
Then you have a flat penalty, which is a certain percentage of the loan the entire way through. That's generally between 2 to 5% of the loan,
Okay.
and that's
Okay.
for as long as you have the penalty. Then you have another penalty, which is 6 months interest on 80% of the outstanding principal balance.
Okay, everyone has brain damage now.
Yeah,
so
I
we'll just
apologize,
pause for a
sorry.
moment.
Yep.
What you need to know is there's plenty of different options depending
Yeah.
on what it is that you're buying and what the plan is as far as your hold period.
Correct.
Yeah, perfect. Now that we've talked a little about bank statements, we want to get into hard money options, right? So
Sure.
hard money or private, depending on where the source of money might be coming from.
Yep.
But hard money is another category where it certainly serves a specific client in some cases, right?
Yes.
More than others.
100%. So let's say a hard money loan might be a loan where the borrower otherwise doesn't qualify for the conventional bank statements or debt service coverage ratio, or the property itself doesn't qualify. As an example, you might have a great property that you know is going to be a great investment, but it needs $200,000 of rehab.
And the property doesn't qualify, just to clarify, meaning it doesn't make enough income, right, to qualify you for debt service.
That
Option
side, or
or
it could be
the
that it's not
condition.
habitable. The condition could be not habitable,
Okay.
which is oftentimes why there's an opportunity.
Right.
And because the property is not habitable, the banks can't finance it because it's not a habitable property. You can't get a non-QM loan. You can't get a bank statement loan, a debt service coverage ratio loan. You go to a hard money loan.
So now it's the opposite. You have the income, but the property's not in good enough shape. Right?
Correct.
Before it was you didn't have the income, but the property might have been in good enough shape for
Yeah,
financing.
and it could even be you don't have the income and the property's in tough shape, but you have a big enough down payment, or the hard money investor, lender understands enough about the market and knows it's a really good buy.
In other words, having someone like Mark who knows all the options and how to play the game of arriving at highest and best
Yes.
based on yours is really critical, because that's the skill part, the experience part that not enough weight and value gets put on in some of these categories for our professional services.
Yeah, I mean,
It's huge.
yes, if the property is a cookie cutter and everybody in the world can finance it, then everybody in the world can finance it.
Great, yeah.
Once it's not that, then you kind of need somebody with a brain.
Yeah, then things really start to narrow out as far as who can help you out and what they know to help you out.
Yes, 100%.
So with the hard money, the property doesn't qualify just based on the condition that it's in, and so they'd be looking at, from a lender standpoint, how would you qualify for that property?
Generally, it's just a certain amount of equity. So they might say, look, I want 25 or 30% down. Their interest rates would be higher than the bank statement or debt service coverage ratio loans. The fees would be higher, so it's a more expensive loan. It's an easier to get loan.
Right.
There could even be a situation where somebody calls and says, I have to close this loan in 10 days. Well, we can't do it on debt service coverage ratio or on bank statements. You just have to get the deal closed. There's hard money lenders that'll close the deal in 10 days.
So this is how you're gonna find out if you really have yourself a deal.
Yes.
Because if you don't have a deal, you're not getting this opportunity, you're not getting hard money.
Correct, and it wouldn't be worth it even if you could.
Right.
Yeah.
But in your eyes, you might have thought it was an amazing deal, which oftentimes happens, right?
Yes,
So,
100%.
but this is where you have a tremendous opportunity because the price is right. Price is right, you've got enough margin in there where you can do repairs, and they know confidence that either they'll take it back and sell it at a profit, or they know you're gonna be able to refinance out of it and get the loan to replace their position.
Correct. They just know there's enough equity there that once the property is stabilized, they're going to be taken out and paid off, and if not, they're going to continue to collect the high interest. And if for some reason you didn't stabilize it, they would take over the property and they'd be comfortable and they would, be in a good equity position from day one.
So your amazing opportunity that you started with is no longer really an opportunity at all. It's really a debt for you.
Correct.
Okay, so with the hard money loan, what are they looking at in order to qualify the property and you to buy the property?
It's really specific. Hard money is also known as private money. There's just private lenders. There are private lenders in San Diego that will fund any property in San Diego up to X dollars with 20 or 25% down.
So hard money and private money, same thing?
It's the same thing.
Okay.
It just depends on, think of it as a highly localized market where there's a good chance you'll actually meet the lender who arranges the loan in person.
I thought private money was like these guys in suits, right? They're in the secret room. You can't get in.
Yeah.
But somehow the money comes out if you have the right.
Yeah. No. It's all the same thing. Hard money, private money.
So, but they're not private. They're still available and they're public.
Correct. It's just they're generally not advertising out in the marketplace. You're not going to see them. We used to say in the old days in the newspaper.
Okay.
Yeah.
Fair enough. I'll stop reading the real estate section of UT then.
Yes.
Okay. So perfect. So the hard money is really about the opportunity if you can demonstrate to them based on your purchase price, the budget that makes sense, and the value after you complete repairs, that there's the appropriate ratio, so to speak, right?
Yes.
Then you're good to go, and you can generally fund those in a matter of 7 days?
7 to 10 days. It can be really quick.
Okay, cool. So that sounds like a get out of jail free card if you have the right deal.
If you have the right deal, you can get into it, and yes, it allows you to get in.
Okay, perfect. So when they call you to get that 7-day close done, what do they need to have with them?
Property address, purchase price, down payment.
And a budget?
The first three are the most important.
Okay.
The budget, you can work around it, whether you include that in the loan or whether they're just doing this loan just to buy it.
Okay.
A lot of times when it's fast, you're just going as quick as possible just to get them into the deal.
So that's hard money. That's pretty straightforward.
Yep.
Really just bring the right deal forward. And
correct.
Thou shall be lent on.
Correct.
Okay.
Yes.
Now, let's talk about debt fund, right? You mentioned that. That's something that I don't think many of our listeners or audience has probably heard of. Like, what is that?
Yeah, so debt funds also kind of play in the private or hard money space. They play in between that non-QM bank statement, debt service coverage ratio, and hard money space. Well, the way you'd want to look at it is, it's kind of like somebody who would use a hard money loan, but they might use 4 or 5 of them in a year.
Okay, so this is someone who's building a track record and building a relationship banking lending type.
With a non-bank debt fund.
Okay.
And that debt fund will lend them either one, they'll be more aggressive in terms of price than a hard money lender, or 2, they might be more aggressive in terms of the terms. They might say, you know what, we don't need 25% down for you. You've done 4 deals with us. We'll do 15% down now.
So does someone call you on a black phone and say, Mark, congratulations, you're now in the private club?
No, not at all.
How would someone know, or like, how would they even get into this type of product?
They'll start doing more and more deals. And as you start doing more and more deals, if you're doing 3 or 4 deals a year, you're getting pretty busy. And 3 or 4 deals a year in San Diego, you're doing $2-3 million, $4 million bucks a year worth of deals. Right. It makes sense to get lined up with a debt fund and start to get a pretty solid understanding of, hey, if I want to do this and I want to bring in an investor and I want to be the one running the deal, can I do that with you? Can I?
So like, so let's say they're working with you you're recognizing, okay, they are active. They're doing a handful of deals. And then that's just something you say, hey, by the way, based on what you've accomplished or done in the past 12 months, I wanted to introduce you to...
Correct. I would introduce you to this debt fund or this particular lender, and instead of each time you're doing this, you got to put down 25%. You can do it maybe with 15%, but it's worth you taking some time to meet them and to see what their programs are.
So the more you do, right, and the better or the bigger track record you have, the more doors can be opened up and the more options at a higher level, right, that allow you to continue doing what it is you're doing successfully.
Completely, yes. It starts to open up a lot more.
Okay.
Yeah.
Is there any other types of products or conversation in this space that you believe we should speak about, or do you think we covered them all?
I think we covered all the big ones. There's some little
Agreed.
niches here and there, but we covered all the main ones, and I think it's a very good start.
Okay, great. So I trust that everyone on the call today was able to grab a few pieces of good information that will help serve them, but most importantly, to set them a plan and take appropriate action. Because quite frankly, all this information is really worth nothing if you don't put it into action or application in some capacity for yourself or someone you know that's in this space or maybe didn't know about this space. So Mark, thank you very much for your education, your time. And for you listening, if you're curious kind of what will you do next, well, you'll call Mark and he'll help walk you through kind of a consultative approach of what is it that you're trying to accomplish. Maybe you don't even have a deal yet. Like, this is typically the best time to have the conversation. Say, hey, Mark, I'm reaching out to understand the landscape, tell you more about what my environment looks like so that you can provide me the appropriate advice to win when the opportunity presents. So I know it's going to come because I'm focusing on it. Or I don't know what that opportunity is. I just know that I have assets, right? And I want to help my kids out down the road in some way. Or I don't want to be able to not help another family member because they're not as well positioned. So like all these things are just important to be in relationship with the right people so that you can take the right action or have the opportunity to do anything about it.
100%. Yeah, I would say having an initial call is super critical. It doesn't matter if there's a deal there or not. Just understanding the basic rules of the game.
Mark and I just went through this personally the past couple weeks, right? Talking through purchase opportunity and really helping me understand all the different options I had available to me to really arrive at what I felt was the best suited for me at this very moment and to make better decisions and plays in the long run, knowing these are other alternatives I didn't previously know about. So that's what this is all about. So Mark, thank you very much for your movement time. And have a wealthy rest of your week. We'll catch you on May's Wealth Call, and trust you'll be out making wealthy decisions here.
That's it.
All right.
Thank you.
Until next call, take care.